Good morning. Unfortunately, due to agenda restrictions, I have to address you remotely, but I really did not want to miss this opportunity. The topic proposed could not be more appropriate to the task that policymakers face right now. My standpoint is clear. We need a broad-based recovery with a truly European spirit. The pandemic had a large impact on economic activity. Last year, GDP contracted 6.3% in the European Union, the deepest annual contraction observed on record. This was concentrated in the first half of the year as activity recovered strongly in the third quarter. By then, the more stringent confinement measures were partially relaxed and agents showed a remarkable capacity to adapt to the new economic environment. Contraction was broad-based, even if with different magnitudes, so we cannot ask for less than a broad-based recovery. The ECB provided favorable financing conditions for all sectors. It is our duty to make sure that no sector is left behind and that viable firms will have the necessary support. But this also requires fiscal policy. We can now be sure that, contrary to previous crises, monetary policy was not the only game in town in 2020. Initially, the economic shock was symmetric. The severe lockdowns hit all sectors and global trade fell dramatically. Services and manufacturing were severely hit. The global composite PMIs plunged in early 2020 from an expansionary stance in January to a deep recessionary level in April. However, following a sharp contraction of industry in the first semester of 2020, the sector rebounded strongly. The recovery in international trade of goods was also fast. The Portuguese experience shows exactly this. Exports of goods, other than energy, grew year on year in real terms in the second half of 2020 and repeated exactly that in the first quarter of 2021. Nevertheless, activity in contact-intensive services remained depressed. The European Union services PMIs has just returned to expansionary territory in March 2021, after a prolonged contractionary period. The labor market presented a different pattern from that observed in previous recessions. Policy measures preserved employment and limited the increase of the unemployment rate. This is the best condition I can think of to guarantee a broad-based recovery. European firms avoided the destruction of hundreds of millions of years of accumulated human capital as measured by years of tenure, in sharp contrast with price rises. Firms and member states invested astronomical amounts of money to preserve employment, and workers too, as they agreed to more flexible hours of work. All rules of thumb relating employment and economic activity broke up. In truth, potential output is more latent than ever, but the behavior of investment, abound liquidity, temporariness of the crisis, and employment resilience hint at a small impact. And more importantly, they hint at a path for recovery. The resilience of tax collection in many economies is yet another sign of this resilience. Take Portugal as an example. Personal income tax increased against all odds given the profound recession. Going forward, we expect economic activity to recover gradually, supported by a continuation of the strong and decisive policy response and the rollout of the vaccination progress. The joint impact of the monetary and fiscal policies has been crucial and has to be preserved. As I have mentioned before, monetary policy acted to preserve favorable financing conditions in financial markets. A generalized backtracking in monetary policy may be ill-advised. At evaluation time, it is useful to consider the counterfactual scenario without the strong monetary response with both conventional and unconventional measures. The 4 trillion euros of asset purchases and the 2 trillion euros of liquidity provisioning did make a difference. Absent such policies, the materialization of a disruptive scenario would be more likely, and Europeans recognize it. The best way to recover from a crisis is to have strong and credible institutions. This is why nowadays the euro has the strongest support ever among European area citizens. 79% show support for the euro in 2021, up from only 62% in 2013. As former president of the Eurogroup and now part of the Governing Council of the ECB, this is exactly the type of outcome we dedicate our effort to as policymakers. The same impact applies for fiscal policy measures. Fiscal policy should proceed and be adapted. It always allows us for a more targeted action where it is most in need. For a sustainable and inclusive recovery, we need fiscal policies that duly consider the asymmetric evolution of the crisis, but also fiscal policies that provide the right incentives. As uncertainty begins to fade, the focus should be on job creation. This helps the reallocation of resources if needed, and reallocation is not necessarily bad if income support is available for workers in the transition stage. We should not fool ourselves. The decisions taken in 2020, brave as they were simpler to design than what comes next. We should direct public resources to those in need, and we must address the needs as they evolve in a targeted way. Faced with an asymmetric reality, choices must be made. All economic agents must participate in the effort to put together the recovery process. This time, leaving sectors or fractions of the population behind is not an option. Leaving all efforts to the public administration will be a failure. No single sector can handle the recovery by itself. A word for the role of prudential policies, both micro and macro, and to the role of banks. Banks have been able to maintain the flow of credit in the economy. The European Union banking sector entered this crisis in a more favorable situation in terms of the quantity and quality of capital, a significant improvement in banks' capacity to absorb potential losses. However, risks persist. Prudential policies should continue to promote the lending activity with fine-tuning a balanced build-up of risks. We need an integrated and truly European approach to achieve a recovery across sectors and countries. Coming to the motto of our event, technology. Technological development has been part of our economic and sociological landscape already for decades. At this stage, it will impact on the entire value chain of products and services and therefore frame and promote the economic reallocation of factors to a more efficient and climate-concerned usage of resources. Promoting digital financing will support the EU's recovery of the economy and transformation in general while reducing risks. Further development of the European digital financial sector will reinforce the European Union's strategy, autonomy in financial services, and the ability to safeguard its financial stability and values. An increasing number of central banks worldwide are examining the possibility of introducing digital central bank currencies. The ECB is among them. In view of digitalization, the rapid evolution of payment markets and the emergence of crypto assets, the ECB is studying the possibility of issuing a digital euro in addition to the cash and payment solutions offered by the private sector. Europe should continue its way forward, paying tribute to the leap of integration observed in the spring of 2020, from the structural reform of the budgetary instrument for competitiveness and convergence by the Eurogroup and European Council at the end of 2019, to the 540 billion package and the 750 billion euros of the Next Generation EU in mid-2020. We don't need to raise old worries. We cannot revive moral hazard concerns which were successfully curbed in the pre-crisis period with the reduction of NPLs, with the capitalization of European banks, with fiscal balances at their medium-term objectives, and public debt falling in all euro area member states. Broad-based requires moving together. Now that we regain multilateralism, now that we learn how to deal with the pandemic and vaccination, we cannot afford an economy with segregated labor markets and without convergence within and between countries. We now understand that what global challenge is. Let's race to the moment. And thank you very much.